Tomorrow is going to be the Federal Reserve's decision. We're going to hear from Jerome Powell about what this rate cut is going to be. 65% of the market is expecting a 50 basis point drop, while the rest of the market is expecting a 25 basis point drop. In my opinion, neither of those aspects really matter. What we want to hear is how dovish Jerome Powell sounds within the press conference. So the actual decision, the market might react to the upside or the downside, but it's the press conference that follows, usually at about 2:30 p.m., that we are more so interested in. And the reason for this is that the actual basis point, whether it's 50 or 25, doesn't matter. What we want to know, especially from this press conference, is what's the outlook for the rest of this year. Are we going to get more cuts into December and maybe 5 more into 2025, which is what was expected? Or does he come out and say that instead they're only going to do 3 or 4 cuts in 2025? How deep of a cut at this point does not matter to me. It is the fact that the rest of the cuts are going to be sustained. If we have 2 more this year and then 5 next year, that is going to really help the market short term, because it means that it's going to affect the consumer much quicker, which is better for the market, because when pricing is better for the consumer, we're going to go out and spend more money, which is going to grow GDP. Now, with all of that said, taking a look at Tesla for the past couple of weeks, we have been very, very bullish. You guys know that we played this massive breakout back here in June. We were waiting for this pullback into our institutional and smart money area so that we could start to accumulate long once again. At this point, I am holding February calls, and we've been playing this nice breakout up into this $230 range. For the past couple of days, I've been saying that this $230 range is basically the level we have to take out in order to confirm the breakout back to $260 and $300. This area is called a liquidity level. The reason that this is a liquidity level and not just a normal resistance is because of how many times price has perfectly pushed into that level and rejected. You can see we have 1, 2, 3, 4, 5, 6, 7, 8 candles where price pushed into that liquidity level and rejected. These areas are usually where they trap retail traders. So when I say institutions and smart money, that's Wall Street. That's these guys who are buying at very, very discounted levels. They're the ones who move the market. They're the ones who are going to do what's called stop hunts and liquidity draws, where they purposefully drive a stock through its support, tag everybody out like they did back here, and then allow the stock to continue to run. Now, the more times that we test a liquidity level, the higher of a chance that we call a sweep occurs. So a sweep happens when price finally pushes through that level, tags all of these short stops out, and then we get nothing but massive buying pressure because we're finally through this liquidity level and price breaks out very, very aggressively. Now, if we zoom in from the daily down to the 1 hour, you're going to notice that we have been making consistent or equal highs. If you want to learn more about all of the indicators that you see in this video, as well as the proprietary settings and the step-by-step trading system that I've built, you can take all of our courses completely free with the link in the description. This liquidity level right here at 230 to 234, we keep continuing to hit it. So when price is making equal highs, that's a sign that we're going to continue to compress. When price is compressing like this, the only thing to follow a compression is an expansion or a capitulation, which is basically a break to the downside. Now, when price is making higher lows into equal highs, there's usually a very high chance that this liquidity is going to be swept and that price is going to break out. I did open a hedge position, some October puts on Tesla last week, just in case we end up rejecting at this level and we come back to test $200 one more time. But in my opinion, I don't think that that is going to occur. Because if we look at the weekly and the bigger time frame chart, you can see that we have a lot of bullish pressure here and buying occurring. One of the things that's extremely important to understand here is that over the past couple of years on this weekly chart, price has continued to make lower highs until we finally did what's called a break of structure, where price broke over this old high. This was the indication that this downtrend has also shifted. The way that you could also tell if you didn't want to do that is by using the market bias, which is one of our favorite indicators to use within our courses and our academy. And this is going to show you once it switches from red to gray or green that we're now in a bullish uptrend. The other good sign here is that we have confirmed bullish accumulation. This occurs when we start to see higher lows on the BX trender. This means that there's actual money coming in behind this. And you can see last time we had this type of accumulation, price was holding still while the bulls were buying. And that's where we got that massive breakout. And so at the end of the day, we have to see this push through $230 tomorrow. If this liquidity level cannot be taken out, and we end up rejecting off of $230, then we will most likely see Tesla pull back one more time to $200 and $190. That would end up breaking this 210 level and selling off and creating a bear flag. This is why I'm holding two types of positions. I'm holding calls and puts right now at the same time. Once price takes out this liquidity level and it's confirmed, I will remove my put position, take a small realized loss, but from there, we will have nothing to stop this all the way back up to 270 and 300 within the next month and a half. However, if price rejects from here, I'm going to hold my put back down to 200. I'm going to take a small loss on my calls unrealized because I'm not going to close them out. I'm going to take my put off the table at 200, so I'll cash it in for a profit. Then I will average down on my February calls at 200 and 190. This way, I'm protected no matter what happens. I might take some short-term realized losses, but that's okay. As long as we're protecting capital, that's all that matters. Last week, we did an entire in-depth video on delta hedging, going over it specifically with Tesla and setting this trade up. So I highly recommend you go back and watch that video. Thank you guys for watching the video. If you want to trade alongside of me each and every single day, get access to all of my real-time alerts, private live streams, as well as a trading community of over 800 other traders using the same exact strategy that you see here each and every single day. If you want to join the team, you can use the link in the description to join the private mentorship group. If you don't feel like you're quite ready for that, then take advantage of all of the free courses that we have on our website. Thank you guys for all the support, and I'll see you next time.